Hello, everyone, and welcome back to the anti-bubble report. We're going to move to, I think, a critical section, which we'll discuss the central bank trap. We are at the end of, we just started 2022. We are looking at the possibility of the first hikes in March. And this is a new regime, a new paradigm that it's going to be very different from previous cycles. So let's look into and try to address a lot of key questions, such as the hikes in interest rates, how far can we go, the pace, what it means for balance sheet, dollar, inflation, etc. So I think here the background is this idea that we've discussed about how central banks have been trying to print their way out of trouble, print their way out of the problem with all sorts of measures that have included zero rates, QE, negative nominal yields, pushing effectively beyond government bonds into credit, doing giving checks to people, financing spending, pushing currency and trade wars, all sorts of things that effectively eventually lead to currency devaluation, as Voltaire's dictum of paper money eventually converges to its intrinsic value, which is paper. And I think here I love this graph because it gives us a very clear picture of what's happening and giving you a perspective of interest rates, in dollar interest rates in blue, short-term interest rates, Fed funds, versus the balance sheet. And this is a history of the past 2 decades. And once upon a time, we had interest rates at 6.5%. We had the dot-com bubble, which sent us all the way down to 1%. Still no QE. Things did recover, and we had this mega growth in commodities in China, etc., which eventually led us to the Lehman, the global financial crisis. And what we saw then was already pretty meaningful, which sent interest rates to zero. The US started out with the printing machine, and we saw in QE1 increasing the size of the balance sheet, sort of plugging the hole from the banks. QE2 and afterwards, with the currency wars pushing euro dollar very high, and also the yuan, which was pegged against the dollar, all contributed, in my opinion, to the crisis that followed in Europe. And we had these currency wars that brought QE3, in my view, a mistake, and it wasn't needed. But eventually, we had the famous taper, so slowdown in the purchase, the size of purchase and the purchases of government bonds, which eventually stopped. And it did take quite a while between the end of the taper, as we can see, and the first hike. But once the hikes came, we're sort of in autopilot, as Powell called it, and we even got to a point where we did quantitative tightening, which was effectively the reduction of the balance sheet by not rolling over existing some of the debt that matured, and you have effectively interest rates reaching a point of 2.5%. Big banks, and the consensus was, things will normalize, and we have another 3-4 hikes along the way. And then Q4 happened. Q4, for those who remember, was a very negative shock. Things were saved around Christmas. People like GE or others were in the brink of collapse, if not already pretty much technically defaulted. And they were saved, and we saw interest rates going quickly to 1.5%. And I have to stress that the system blew up at 2.5. We required this move down and the reversal. It basically printed money, and this is all pre-COVID. Once COVID hit, it was a complete new game. Rates back to zero, brutal expansion in balance sheet, MMT effectively printing money and giving checks to people, and this is something that again has continued, and it's led us to a situation where the key questions we've been facing is, okay, how long are we going to stay at zero? How long will we keep the taper? And we have answers for these. We are effectively, the expectation is the end of the QE by March, and we're looking also at the first hike, and the market now pricing 4 hikes into the year. So and even talks of runoff in balance sheet. So a much more condensed, faster cycle, both on the way up and way down. And let's see what this means. This graph complements the previous one because it gives you one more dimension. It's not just looking at short-term rates, Fed funds. It also looks at long-term rates. And what is interesting for me is that when you look at the good old days, you had a short-term rates and long-term rates, where long-term rates were in some ways acting as a predictor of the cycle of where things would end up. And this is the reason why the inversion of the curve is often a big signal, as we could see in other periods, because what it's telling you is, to some extent, in a curve where short-term rates are lower and long-term rates are higher, this is giving you an expectation. But there are times when perhaps short-term rates get carried away versus the forward, or vice versa. But what we saw in the run-up towards 2018 is interesting, because long-term rates were actually telling you this story that you could comfortably hike to maybe 3.5%. And unfortunately, things did crack before we got there. Right now, the picture is somewhat similar, in the sense that we've started to see a move up in rates. You see the green line on the bottom right, with the 2-year moving very fast and pricing these hikes. But to what extent is this, are long-term rates a good predictor of how far we will go? Are they telling us also a different story with respect to inflation, which is, as we'll see shortly, a little bit out of control? And how does this contrast with the views from the Fed? And what you see here is the famous dots. Each dot represents a vote from a voting member of the Fed, and it gives you a sense of where they see interest rates over time. This is the latest plot. Interestingly, as we'll see, relative to the previous one, there's been a pretty notable convergence in terms of the views, and no change in the long dates, but an acceleration of perhaps the consensus move much higher in terms of the hikes into the next year and beyond. When you look at the long-term trend of where they see what they define as the terminal rate, we see that the terminal rate has remained around 2.5% for a while, but historically it's been always coming lower and lower. And this is, I think, at the core of the problems that we face, because we've been relying on lower interest rates to basically borrow more. And we'll go through this over and over again, because in the times when interest rates are low, you increase debt, and when things are good, you try to increase interest rates, and turns out that you can't afford it. And so we have this permanent shift down that is effectively going hand in hand with the second big driver, which is trying to borrow your way out of problems. And this has the dimension of spending and of debt, fiscal, taxes, bailouts, MMTs, checks, trade wars, and everything. And so this fiscal dominance, which is also driving and going hand in hand with monetary policy, we see how we are effectively printing money to finance the government and beyond. Is it as simple as that or not? And what we see obviously is that as you print a ton, then you're going to get inflation, and this is something that is desired. I mean, central banks are looking to have this third lever of inflate your way out of problem. For the longest time, they used 2% inflation target as a ceiling. They introduced the idea of the average, which would give them more freedom, quite a lot, because we've seen inflation spiking to 7% in the latest numbers. So pretty huge deviation and absolutely ginormous numbers. Interestingly, inflation expectations are going up. Hard to argue that central banks are independent. They're not. They're definitely trapped and appointed and doing things on behalf of what I'm sure they think is best, but ultimately financing government spending and debt, as is the case not only in the US but also in Europe and beyond. The inflation debate is not as straightforward. There are obviously strong forces in both directions, and there are many deflationary forces such as technology or demographics or overproduction, overcapacity, malinvestment, even bubbles. But there's this one single force on the other side, money printed, that can offset them all. So it's almost like the more deflation you have for good or bad reasons, the more room central banks have to print, and they will take that room. What is worrying, and we'll talk about this in more detail, is inflation expectations. I think central banks are in control in a low volatility environment. They lose control in a high volatility and high inflation environment, and the impact of inflation on and inflation expectations on purchase power and growth and many things is very damaging. So I think, and I've been arguing this for a long time, I do believe we've passed the point of no return. The rules of the game have changed, and we might see a world where you have inflation and zero interest rates. I think central banks will struggle to normalize monetary policy, because they will see that by doing so, they burst the bubbles they created in the first place. And I think it's important also to bring another dimension. We'll just focus on the 10-year for now, and also take a historical perspective on nominal rates, so what you see, and real rates, which is what you get after inflation. And this is pretty fundamental. We've seen inflation somewhat contained, at least official inflation. We all know that your basket or my basket is very different from the official one. And guess what? The official basket is significantly lower. But we see that the historical gap was pretty contained, and the move down in nominal rates with stable inflation meant that you were basically getting lower and lower real returns on your money. With the European crisis and GFC, we actually saw negative real yields. So the compensation that you get for your money is not sufficient to protect you against inflation. So you're losing purchase power. On a 10-year basis, we managed to sort of go marginally back to zero or positive territory. But following COVID, this became again much deeper. And if you look at the outlook, personally, I think that nominal rates, whilst they should go up and they will go up, they have very limited room, and we might see a reversal on nominal rates down eventually, back towards zero, following sort of the path of Europe and Japan. Whereas I think inflation will remain stubbornly high even if there's a plateau effect with what's happened and base effects that might slow down the rate of inflation, the compounded effect, but in some ways the damage is already done. And you see this when by widening again to different time frames, we see how inflation break-evens are arguably breaking out and highest in pretty much since in the last 15 years. And this is something that I think worries central banks more than inflation itself, because inflation expectations can actually take things out of control. And this is why I think we're caught in this situation. I summarized the last decade as the transformation of risk-free interest into interest-free risk, and how the implications are significant. There's no such thing as risk-free interest. There's nowhere you can just park your money and earn real positive returns. In many cases, not even in nominal terms. This has implications, as I discussed in a previous section, on asset allocation, and the 60-40 balanced portfolio is not balanced anymore because fixed income has lost that defending power to a large extent, particularly in places like Europe, where we're already negative nominal yields. But very importantly, I think artificial low interest rates are primarily responsible for artificial valuations. And you don't need to be a genius to understand that if you're valuing assets by discounting cash flows, and you have a very benign view of the world in terms of what those cash flows would look like through growth and earnings and stuff. But worse than that, you actually have a very benign expectation on the present value of that because you're using artificially low interest rates, then you get massive bubbles. I mean, you see the PV of $100 at 5% over 50 years would be barely 9 cents on the dollar, whereas at 0% is par. So this is the level of, I mean, in assets that have high duration, such as tech, this explains the sort of explosive, X multiple that we're seeing, which in my view is largely driven by the duration we'll discuss shortly. As a result of this, you've created these artificial low rates, create these bubbles that are by now too big to fail, and they create this wealth effect, and they also make it difficult to normalize things. It becomes almost science fiction. So we'll see if we are wrong as the Fed tries to normalize, but I think it's a little bit of a joke that we're talking about fighting inflation with moves in rates of 0 to 1% or 1.5% or even 2%. Think about what Volcker had to do back in the day to fight inflation properly. And I would argue that what's been done recently is in some ways much worse than what they faced then. So going back to this point of duration, I recommend, if you haven't read it yet, you take a look at my colleague Alfonso's piece on equity, no premium and equity risk premium, which makes two key points. Generally speaking, people would argue that equities are expensive in historical absolute terms, but or high, but they don't think they're expensive in relative terms if you compare them to fixed income. So everything is theoretically cheap when relative to zero or negative nominal yields. The thing is that there's a lot of common mistakes that are made, and one of them is we tend to compare the equity risk premia with 10-year treasuries. But the fact is that if you look at the duration of these risk assets, we find in our analysis that the S&P is closer to 28, 30 years, or the Nasdaq could even be 40 or even closer to 50 years in duration. So comparing 10-year to 30 or 50 year would be more accurate. Would be comparing apples and pears. If you actually look at the equity risk premia against its equivalent in duration terms, you see that equities are expensive both in absolute and relative terms. Related to this, we see the wealth effect, what I call the central bank's frenemy, because at the end of the day, it has a big impact. These bubbles create the illusion of wealth. People do actually feel rich and they spend up more money, incentivize consumption, etc. The problem is these things are artificial, and when they reverse, the frenemy becomes an enemy, and this wealth effect actually creates devastation. Think about all the day traders that are now quitting their jobs to day trade because they've been very successful trading crypto or a one-way street. Sadly, it's not as easy as that, and I think we'll see what happens. But I've seen this movie already in 2001, and I think there's a lot of similarities to what might be ahead. When you look at all the drivers and we see these artificial low rates, etc., and it's pretty much clear and obvious why buybacks have been so extended, and how companies have been using liquidity to take advantage of effectively artificially cheap credit. This is, however, creating implicit leverage in the system, because the companies are relying much more on or opening and be more exposed through equity rather than securing certain financing. And this is again a bit of a long-term cycle thing, where we've seen insiders selling at paces not seen in a long time. So with that, I think I would effectively summarize the situation as one whereby, yes, we expect the Fed to hike. They must do it. They will continue to do that until the equity markets crack. We will see if that happens, if and when that happens. But my view is that the level where that cracks is closer to 1%, rather than the 2.5% implied by the Fed. And the implications of these much higher rates are big on volatility, on effects, on many assets, whereby we might see a new kind of a new movie where we might see things that we haven't seen before. But certainly a very interesting year ahead. I recommend caution. It's going to be a volatile run, and I think that strategies that are defensive, long volatility, long inflation, long anti-bubbles could be helpful. And in some ways, the extraordinarily difficult performance of the last 18 months, who knows, might be reversed. So I hope you found this helpful, and I look forward to continuing the dialogue. Thank you.